In this video, we're going to walk through a quick demonstration of our Netflix earnings model. We're also going to take a look at where consensus estimates are relative to management's guidance from last quarter. And then we're going to run some sensitivities on changes in interest rates and changes in volatility to see how this impacts Netflix share valuation. If you'd like to download this or any of our earnings models, visit our website, www.gutenbergequityresearch.com. You can click on the models in focus and then scroll down to the model that you're interested in. From there, you can scroll down to the bottom section and click the Click to Download button, and that'll get you the Excel file. The model is set up consistent with our approach for other companies. In the upper left-hand corner, you have the color legend, which indicates anywhere that you see a blue cell, those represent our estimates. Purple cells represent company guidance, and orange cells represent consensus estimates. Below that, you have the summary of our valuations. So on a multiple-based valuation approach, we have a target of $117, $108 for DCF approach, and using our 50% weighting of each, we get a target of $112.50. Below that, you have the net income statement, the segment details, balance sheet cash flow, multiple valuation summary, and discounted cash flow valuation summary. So you can expand any of these sections to see the details, or if you're not going to model the balance sheet and the cash flow statement, you can keep them collapsed. So just a little demonstration of how we build the income statement. If you scroll down to the segment details, you can see that we have all of the three major segments here: domestic streaming details, international streaming, and domestic DVD rentals. We also have some income statement ratios for profitability and expenses. So for right now, let's just focus on domestic streaming. So for the domestic streaming business, you can see management gave a good amount of guidance for next quarter. So anywhere you see these purple cells. Total paid domestic members at the end of the period is expected to be 42.5 million. The domestic streaming revenue is expected to be just over $1 billion, and the contribution margin is expected to be 32.6%. So if you want to change any of these metrics, you can. Maybe you think that the paid member growth rate will be greater than 3.5%. You want to see what that's going to do on valuation. So let's change this to maybe 7%. Let's say it's double what management guided to. And you can see in the upper left-hand corner, before we do that, our price target is $112.50. So let's see how it changes. Change this to 7. And you can see it goes up to $119. So you can do that for any of these metrics. And you notice that if you change the current period, it's going to change because it's going to keep the growth rates constant. So it's going to change the domestic paid members for each one of these quarters and throughout the rest of the model. You can do the same thing for international streaming and for domestic. So now that we have an idea of how the model works, let's take a look at where we stand relative to management's guidance. So these purple cells represent the guidance, but these orange cells represent consensus estimates. And when the guidance and the estimates differ, we default to the consensus, but we put the details in the comments. So you can see here, management guided streaming revenue to 1.593 million. So streaming revenue excludes the DVD details. So that's not going to give you a really fair comparison, but still it'll give you a little bit of insight into where the consensus is getting their estimate from. The remaining items, we are actually able to keep management's guidance in here and still get back to the revenue and EPS estimates when we apply the contribution margin and the revenue for each one of the segments below. So that's telling us that currently the consensus estimates are in line with management's guidance for the September quarter. Next, we can run our sensitivities on interest rates and volatility. To do that, we're going to scroll down to the discounted cash flow valuation section, and you can see as part of our inputs into our weighted average cost of capital, we have the market's volatility, which is we use the VIX index for, and we have what we're considering the risk-free rate. So we're using the 3-month average 10-year U.S. Treasury security rate. So let's start with implied volatility. So right now we're at 16.63%, which represents the 3-month average. But as of the close of business on Friday, we were at about 28%. So now let's see what happens if we increase this. So obviously we're not going to increase it to 28% because that's just one day, but let's increase it by 1 percentage point. So you can see what happened down here when we did that. The share valuation dropped from $108 to 99.27. So that's a decline of about 8%. So you can see shares are relatively sensitive to changes in volatility. So we'll change that one back. And now let's say the Fed increases interest rates by 25 basis points in September. And let's just assume for now that that 25 basis points comes through on the 10-year Treasury. So we're, again, take a look down here. We're at the $108 mark. Change interest rates drops down to $99.43 per share. So again, that's about a change of about 8% or so. So also very sensitive to changes in interest rates. So that's the analysis. If you found this helpful, please subscribe to our YouTube channel to get all our latest updates, and be sure to check back next week for additional details. Thanks for watching.